CRT is one of the most talked about strategies in trading right now, and at the same time, one of the most misunderstood. You'll see people all over social media posting wins with it, but you'll also see thousands of traders blowing accounts trying to use the exact same concept. And the truth is, it's not because the strategy doesn't work. It's because most people are using it in a very incomplete way. They learn one small part of it, ignore the rest, and then expect consistent results. If you're watching this, the goal is simple. By the end of this, you should understand not just what CRT looks like, but when it actually makes sense to use it and when you should stay away. Because that's the difference between someone who survives in trading and someone who keeps repeating the same mistakes. Most traders are taught that CRT is just about a candle sweeping the previous candle's range and then closing back inside it. That's what everyone focuses on. But that's only the surface level. That's just the first condition. If you're entering trades based only on that, then you're basically flipping a coin. Sometimes it will work, but over time it won't be consistent. Let's slow it down and actually understand what's happening. Imagine price is moving up, and then you get a candle that pushes above the previous candle's high, but instead of continuing higher, it closes back below that high. What just happened there? Price tried to break higher, took liquidity above the previous high, and then got rejected. That rejection is important. It tells you that there may not be enough strength to continue upward, and there's a possibility price could move in the opposite direction. That's what we call a bearish CRT. And in that situation, there's a good chance that price will move down and at least target the low of that candle. The same idea works in reverse for a bullish setup. Price sweeps the previous low, closes back above it, and then there's a chance it moves up to take the high. But notice the wording here. There's a chance, not a guarantee. And this is where most traders go wrong. They treat it like a guaranteed reversal signal, when in reality, it's just a clue. You still need confirmation. So the real question becomes, how do you know if that chance is actually high or if it's just a random move? This is where confluence comes in. You need additional factors that support your idea. Without them, you're just guessing. The first and probably the most important factor is SMT Divergence. This alone can completely change your win rate if you understand how to use it properly. In simple terms, SMT divergence happens when two correlated assets are not doing the same thing. For example, in Forex you have pairs like euro and pound, or gold and silver. In crypto, you have Bitcoin and Ethereum. These assets usually move in the same direction because they're highly correlated. Now imagine gold is moving down and it breaks a previous low, but silver also moves down and fails to break that same low. That's a mismatch. That's where divergence forms. And when divergence happens at the bottom, it's considered bullish. It suggests that the selling pressure might be weakening. Now connect this with CRT. If you're looking at a bullish CRT, meaning price sweeps a previous low and closes above it, and at the same time you see SMT divergence, now your setup has context. It's no longer just a single candle pattern. You have a reason to believe that the market might actually reverse. The same idea applies for bearish setups. If price sweeps a high, closes below it, and you see bearish SMT divergence, then the probability of the trade working increases significantly. Another important factor is fair value gaps, also known as FVGs. These are areas where price moves quickly and leaves an imbalance behind. The market often comes back to these areas before continuing its move. So let's say you get a bearish CRT, price sweeps the high and closes below. Then as it starts moving down, it leaves a fair value gap. That's a good sign. It shows momentum. But it gets even better if the structure becomes cleaner. For example, price leaves a gap, comes back into it, reacts, and then continues down, leaving another gap. Now you have multiple imbalances supporting your direction. This adds more confidence to your setup. At that point, your trade is no longer based on just one idea. You have a sweep, a rejection, SMT divergence, and fair value gaps all aligning together. That's what increases probability. Risk management also becomes easier in this case. Instead of placing random stop losses, you can use structure. For example, placing your stop just above the last fair value gap in a bearish setup makes more sense because if price comes back above that area, your idea is likely invalid. Now let's talk about a mistake that almost every beginner makes when trading CRT. They hold their trades all the way, expecting price to fully sweep the opposite side every single time. And while that can happen, it doesn't always happen. If you always wait for full targets, you'll often watch winning trades turn into break-even or even losses. A smarter approach is to take partial profits. One common method is using the 50% level of the candle, also known as the 0.5 Fibonacci level. When price reaches that area, you can close a portion of your trade and reduce your risk. Trading is not about being right all the time. It's about managing risk and stacking probabilities in your favor. CRT is a powerful concept, but only if you use it with the right confirmations and the right mindset.